Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 30th of 2025. Well, I hope all of you had a wonderful Thanksgiving. As we start the chart pack this week, we're going to take stock of the fact that we're in the last month of the year. A lot has transpired here in 2025. But certainly some important days ahead as we prepare for 2026. What we're looking at here is the Atlanta Fed GDP now. You've heard me talk about this a lot. Does a really good job of forecasting. Where it's telling us we are right now for the third quarter is at 4.0% annualized economic growth, which is obviously very strong. And so we got the first reading of that third quarter GDP number in October. We'll get, we had another revision. We'll get one more before it's finalized. And right now that's shaping up to be about 4%. So if at least some of this momentum holds up in the fourth quarter, it sure should turn out to be a pretty good second half to offset what we saw earlier in the year. As we're looking at this, we talk about the K-shaped economy. Obviously, we've got the Atlanta Fed GDP now, which we've just talked about here. That's moving in the right direction. And then offset that with University of Michigan Current Economic Conditions Index. And so this is a sentiment indicator, which is obviously moving the wrong way. We're going to talk a lot about this and have, frankly, over the last several weeks, but we're going to continue to talk about this kind of divergence in the economy with kind of the upper income cohorts relative to the lower income cohorts who definitely feel a little bit differently, certainly differently about the economy. Showed you this chart last week, and that number was down here around 20. Well, we got some Federal Reserve voting member comments in public speeches this last week. That seems to have shot up to 60%. And some rather kind of dovish comments coming out of some of the Fed speak this week. Again, this number is jockeying around quite a bit. I'd say the odds are probably like genuinely around 40%. This is kind of a knee-jerk reaction, and honestly, I think 20% was a knee-jerk too. But I think there's a case to be made for a rate cut, but there's also a case to be made that the Fed should continue to pause. But I think we will wind up getting a small rate cut here in the December meeting. Something I saw, which was really interesting in the chart pack this week, or the reading this week, was this chart. So we have basically global central bank assets in the red, and we know that we had a lot of leveraging up during COVID. We've had some deleveraging on the part of central banks over the ensuing several years. But at the same time, we've got money supply, which continues to expand. And so this is the part that is inherently inflationary. And as you can see, like going back to 2009, there's a pretty good correlation here. And this divergence starting in 2022 is rather telling because it's rare. And so question is, where do we go from here? Does this breed kind of global inflation or does this breed economic slowdown on the part of the global sphere? And right now, it's very interesting. It's a very interesting question, which we don't have the answer. And we've seen an acceleration here in money supply over the last 12 months. And, we'll just have to see how this plays out. Some economic data here over the last week. We've got S&P Global U.S. Manufacturing PMI, which is Purchasing Managers Index. You can see a diffusion index here. We've got 50 represents our baseline. So anything below that represents contraction. Everything above that represents expansion. So when we talk about U.S. manufacturing from S&P Global, from their vantage point, we're in expansion. That's for manufacturing. Now we go over here to services, we can see the same thing. So, their data is painting a relatively decent picture. Now this number was maybe a little bit less than the estimate, whereas the service PMI was a little bit ahead of the estimate. But again, anything kind of in that mid 50 to 55 range is reasonably solid from our vantage point. Now we have PMI manufacturing finished goods inventories, and this is a very interesting development. So obviously we saw the PMI was above 50, so on the manufacturing side and service side. But here we've got inventories, and what this kind of maybe tells me is you've got manufactured goods ahead of the buying season, maybe bloated inventories. I don't know if this means that we're going to have less production in early 2026 as we work off of these inventories, but clearly what we've seen here is an acceleration of inventory build here over the last several months. So now we'll look at United States U.S. PPI, which is producer prices. Here we've got the data, the headline data we see here is about 2.7%. It was up about 0.3% for the month. We can see at the core, minus food and energy related, you've got 2.6. Producer prices look like you can see here at best at the headline, they're kind of flat-ish. At the core, it looks like they're showing a little bit of downslope here. Then let's break that up into core goods and services. These are both very important numbers. You can see here, if you look at durable goods prices, this is the black line. You've got non-durable core goods here in the blue line, and the overall trend seems to be lower. So essentially less producer inflation that we're seeing right now, which seems to belie this, the theory on tariffs. But again, I think this is a moving target. This data tends to oscillate a bit, so I'm not going to get too carried away, but at least, as we're looking at it in a microcosm here today at the end of November, beginning of December, data is constructive. Here, services, you've got that data that also looks constructive. Now we'll look at some profitability measures. We've got on this side, we've got retailer and wholesaler margins. They are coming in about 1.5% year over year. We did have a little bit of degradation here over the last month. So margins seem to be coming down. So we'll see how that translates into ultimate profitability. And then we slide over to the right. Then we've got margins on capital equipment and personal consumption. And so that's broken out into these two lines here, which both after having accelerated a little bit here in 2025, again, more than likely tariff related, we do see some relief here on the margin. No pun intended. We've got Conference Board, consumer confidence. This is something that we've been following very closely. This is really getting back to that conversation about the economic viewpoints of those with means and those without means, or with less means, I should say. But you've got consumer confidence overall, as highlighted in this black line here. That's the overall number, and then they break that out into subcomponents. So you've got present situation. So how do you feel about the current environment? You can see that that's sliding as well. And then you have expectations, which is noted down here, and that's also sliding. So the expectations figure is actually below the present situation. So there is a little bit more of a subdued feeling out there. The preponderance of the data is showing the confidence is, one, it's going down a little bit, and two, that your forward expectations are not as robust as people feel like things are right now. This is something else that really speaks to the K-shaped economy here, although in this particular chart from University of Michigan, this is current conditions. Remember that one line in the last chart, current conditions, but it's breaking it out by the different income cohorts. And you can see here, obviously, the top third genuinely feel better than the lowest third down here. But you can see that all of these measures are sliding lower. And so this is going to have very strong implications. Obviously we're past election season, but we're heading into the midterm elections, and how this plays out in the early part of the year, in addition to the December, obviously, is going to have, I think, a relatively decent bearing on some of the primary elections in Congress and so on and so forth. But obviously not something that you want or expect to see if you feel like you're going to be in a kind of a sustained economic growth environment here. The one thing I saw that actually gave me some comfort, and I love these contrarian type indicators. And so when you get weak consumer sentiment readings, and then you look at other times where right now we're kind of looking at lower consumer sentiment ratings, as we've obviously just seen in the last several charts. That when you see low readings like that, you typically get a stronger average forward 12-month return out of the stock market. So these numbers are pretty stark here. This it would probably should seem intuitive. So when you have really high sentiment, one, to the extent it's sustainable, you're probably going to increase profits and whatnot, but it could signal kind of a topping here. And so that's why this data is so compelling, that when you have super high consumer sentiment, that maybe you're getting closer to a top in the market, and so your returns are lower. Whereas when the sentiment indicators are pretty weak, that tends to say maybe on balance that you're at a point where you're going to expand economically over the next 12 months. And again, I think that's a very open question right now as far as what's going to happen in 2026. We could have policy mistakes. Obviously, we're looking for a new Fed chair that is likely to be more dovish than even the one that we have now. Obviously, we don't know how all these tariffs are going to wind up playing out, because there seems to be a lot of backing off and a lot of, oh, I didn't really mean 50% kind of conversations going on right now. So again, even amidst weaker sentiment, it does give you some comfort to know that there is history behind returns that follow. Now we'll really dig into some other data. We got retail sales here. We've got monthly data. They were up 0.2%. If you back out autos, up 0.3%. And then this is kind of a different control group that backs out several different things in that basket. And it was down ever so slightly. And you can see here retail sales broken out by the categories. And you've got like gasoline, health, personal care, food services, and dining out. And then you've got furniture kind of in that robustly positive category, and then that's offset by vehicles, obviously. You got electronics and appliances, so on and so forth, clothing, and then sporting goods. Again, these are, you got to take these all in a microcosm, because rarely, unless you're really hitting on all cylinders in the economy, are you going to see all of these things up like 2 to 2.5% at once. But again, not you look at this number, and you look at the X auto number, and these are reasonable numbers. So this economic data it shows some incremental weakness, granted, and some trend line weakness, if you want to look at it that way. But it's not something that throws up the huge caution flag that we're seeing, resoundingly negative numbers down here, because that's not happening yet. Talk about inflation, how tariffs lead into it, and all this conversation we've had this year, right? And so we go back. This is 2007. You've got consumer price inflation, CPI, year over year change. This is based on this left-hand margin scale here. So that's in this kind of aqua line, and you can see you got post-pandemic. Inflation's come down. We had a little bit of an uptick, but mostly kind of slightly down to perhaps slightly upwards here. And then you've got the PMI, which we were looking at a little bit earlier, prices for goods and services. And so they advanced this line 4 months as kind of a leading indicator of where inflation's going to go. And so this is, why I really think if I were in the Fed governor seat, I would really kind of tap the brakes on rate cuts, because if this being the modest predictor that it is, and if you do have an uptick in inflation, the last thing you want to be doing is aggressively lowering interest rates, which is like throwing kind of like lighter fluid on a well-lit fire here. So again, I think this is an important indicator. These are important relationships to monitor over time. And then let's show you on the right-hand scale here, you've got the University of Michigan inflation expectations. And so we show you this from time to time just to give you a sense of what the general public is feeling. And here over the next year, we're looking at 4.5%. So this kind of like dovetails with this moving higher. And then the 5-year inflation rate looking at something that's a lot closer to 3, maybe 3.25%. And you can see how that's been influenced over the kind of the post-tariff tantrum regime here. And so, I mean, these are sentiment numbers, so it doesn't have as much bearing. They call it kind of the soft data because they're just surveys of opinions. They're not like hard data. The consumer price index is hard data, and PPI and certainly PMI is real data as well. So again, I just want to be cautious. I want to be eyes wide open on what's going out there with regard to inflation. Here we have core PCE and the estimate here. Again, we're getting some of this data retroactively because of the shutdown, and we're kind of getting caught up here. So we're a little bit behind. Data looks like core personal consumption expenditure inflation, core PCE inflation likely moderated slightly here to about 0.2% for the month. We've got ADP, again, something else that was affected by the shutdown, the Bureau of Labor Statistics, BLS data. So we had to rely a little bit more on ADP. And, I think generally speaking, ADP and the BLS data tend to correlate. Sometimes they don't. But that's all we kind of had that's all we had to kind of hang our hat on here over the last several months outside of like trying to aggregate a bunch of state related data. Here we show a little bit of weakness continued for really a couple of weeks. So this is basically a 4-week moving average looking out over a relatively short time frame, but again in a microcosm, a little bit of labor softness there. Here we have more labor data. So this is a kind of a ratio, if you will. So this black line here represents jobs are hard to get, less jobs that are plentiful. So when you think about, this, when you have, an increase in jobs that are harder to get, this number is going to move higher, which it is. So that just shows you a little bit of stress in the labor market. And then we overlay that with the aggregate unemployment rate, which here is the kind of the traditional U3 number. And so what we see is, again, a little stress in the labor market. We've got these, these ratios, which are important. And obviously there is a pretty tangible relationship between the overall UE rate and this particular ratio here, hard to get, less plentiful. So you just see here more stress in the labor market, well understood that that's taking place. And this is actually, when you look at it, this is the reason why the Fed is more comfortable to lower rates at this point. So, remember, they've got the dual mandate of stable prices, stable employment. Right now, they're focusing a lot more on the employment situation than they are on inflation. But my point in the last slide was, let's not forget about that. Okay, now we'll shift to some of the regional Fed data points here. We've got the Dallas Fed Manufacturing Index production. Again, these are pretty solid numbers, nothing that would give you any kind of concern on the margin. Now you've got new order rates, which actually have both upticked. You've got current order rates, which were admittedly sluggish for an extended period of time. Looks like we've seen a little bit of an uptick. Again, don't want to get too carried away with the near-term data, but these are positive readings on balance. Now we'll switch and look at the Richmond Fed data. And so we've got manufacturing activity in the Richmond district looking a little bit sluggish and continuing to look sluggish. And this is a trend that has been in place for a little while now. Looking at their new order activity, you've got current conditions still sluggish, but the outlook is better. So that's why it's important to, especially when we're talking about regional economies, that there could be some rather stark divergences based on the industry mix and industry diversification, so on and so forth. And you can clearly see here, Dallas versus Richmond, there are some clear differences in where they're going. Now we'll look at pending home sales in the real estate market, an uptick here. And here in the index, you've seen a real flattening out, real sloppy numbers here for an extended period of time, but a little bit of a fish hook uptick here. And, You can see this data actually, positive. If you go to the FA price index here, you see prices coming down. That's better for affordability. You can see definite flatlining. So the rate of growth is certainly decelerated here on a monthly basis, and that translates into lower numbers on a year-over-year basis. Good for homeowners. I'm not going to say that this is the answer, this is the panacea to all the problems within the housing sector, but it is positive data to see, at least some positivity here in pending home sales and lower prices overall. Now we'll look at house price changes prior year. And this is geographically based. So again, to my point earlier about like different regions are experiencing different shades of economic growth or stagnation here, if you will. U.S. Price change. This is basically 23 to 24. Still had an acceleration, so we see that deceleration now very clearly. We saw that in the last chart. But you can see here, like looking at price changes from September 24 to September 25, you got the Pacific and the mountain ranges showing some degradation in home prices. You've got West, South, Central showing price declines, where some of these other areas, like on the eastern seaboard, New England, mid-Atlantic, and even South Atlantic, still showing positivity. Again, so the point is that U.S. overall, we're showing a deceleration of home prices, but that's not evenly spread through the U.S. Now we're going to switch to some of the market data. So this is something that I think I've alluded to before, but it really does have bearing, right? When we talk about global investing, the U.S. now comprises 75% of the MSCI World Index, and you can see really going back to the global financial crisis how that's changed, and you can see how, I guess from a relative standpoint, how increasingly insignificant Europe is. Japan really just kind of like downslope here, but that's all giving way to the U.S. market, which is interesting at a time where we see, over the last, call it 20 years or so, this being 15, but if you go back to, really 2000, like the number of tradable equities on the public exchanges has gone down from like 8 to 10,000 to, something that looks more like 5,000. And so we've seen a lot of net equity inventory go down, but yet the strength of the U.S. market is really overshadowing the rest of the world. Another chart from Bank of America and their strategy piece, really good, kind of telling, but I want to spend some time on market breadth here a little bit, because this is important to the backdrop in why we've had a relatively decent market this year. Let's start with this chart. So this is a positive development. You can see over the last 3 years, we've had an increasing percent of the stocks in the S&P 500 actually outperformed the index itself. So this is a very narrow year, and you can see based on the historical trends, you got to go back to pets.com and some of this other like tech bubble years to see how poorly the market actually performed from a breadth standpoint. Well, that improved in 2024 and continued to improve somewhat here in 2025. So now let's look at the other side of the coin. So, we've got, about a third, slightly more than a third of the stocks outperforming the index, but you've got a little bit more than a third of stocks that are actually in a decline of 20% or more. So this is, again, this is not your father's or certainly not your grandfather's S&P 500. And what's very interesting, and of course you go back to 2005 here, and so this does oscillate quite a bit, but when you have the haves, right, you got to look at the other side of the coin, and there definitely have nots here. There's index constituents that are grossly underperforming that index to the tune of at least 20% or more. Now we'll talk about Mag 7. So this is really the essence of the story here. So and I want to kind of kick it out and look at it on a global scale. So when you look at the U.S. market, I think it's clear that the Mag 7 has been the primary influence here. So if you look at this chart, you've got global ex-U.S. And looking at the equal weighted stock prices, and then you look at the global ex-U.S. versus the Mag 7. So what's really interesting here is that you've got basically tech stocks in the U.S. that are greatly outperforming tech stocks globally by this chart. And then you slide over here, and then you look at tech stocks versus ex-tech stocks in the global sphere. And honestly, you've got global non-tech equities that are actually holding their own against U.S. tech stocks because the international markets have been so relatively strong. So on this slide, we kind of look at things a little bit differently here. We'll kind of break it out by quality in this chart. So this is the MSCI Quality Index versus the Broad Index. And you can see that ratio is just over 1.05%. So they're basically close to the long-term average here. So looking at it from that standpoint, then quality stocks are pretty equitably priced based on their historical relationship with the broad market. And then here we've got the median forward price to earnings ratio by index weight, and you can see the top 10 stocks here are trading about 27.4. Overall index is 22. We've talked about that a lot. So you've got essentially these tech heavy stocks that are trading at a very premium multiple, but they also have very premium cash flow and growth characteristics. And then when you break it down by the next several layers of company size within the S&P 500, you can see that those multiples get much more agreeable. So while we look at MSCI over here, which is a global index, and you've got quality that's trading kind of in line, you've got a lot more of the non-tech quality stocks that kind of fall into these buckets. And when you think about it in that standpoint with the overall index, and generally having better cash flow, better return on equity, and a lot of better measures from profitability and return standpoint than we saw in the S&P 500 like 15, 20, 25 years ago, that these multiples seem a heck of a lot more reasonable when you break it out of the Mag 7. So in a short segment on kind of how the market turns a little bit, seems like it was just a couple weeks ago I was talking about all these different factor divergences. So for a long time you could see the downward trend here going back to the beginning of last year that value is greatly underperforming growth. Well, that actually turned around last week. And then we have small cap versus large cap. And that had been trending down in favor of large caps, and that seemingly has just like modestly turned here over the last month or so. And then we talk about the equal weight index, which we were literally just talking about on the last slide, that the Mag 7 outperforming the equal weighted index. And again, we have a little bit of an uptick here. So again, maybe it's habit forming. We don't know. But these are different kind of factor estimates that are important to watch. And I think it's also important to kind of be on guard for inflection points potentially. Talk about insider buying. So health of the market is measured by a lot of things. And one of the things that we look at is kind of an indicator of sorts is the insider trading habits. And when you have a number like right now where you've got a spike in insider selling, that tends to suggest, theoretically that, you've got executives that know that maybe there's some slowness coming on the horizon, and so they're going to sell and kind of max out their benefit, right? Because they would have superior knowledge of the business environment that their companies operate in. And so that's the reason why you tend to become a little bit more bearish when you see spikes in insider selling like we have. And again, we've seen, a lot of changes over the years, and there are a lot of different reasons why insiders sell stock, not just because they feel like the environment's economically is going to turn over, but it is important to at least look at and consider in the calculus of all the other things out there that we watch for market health. We'll slide over here. Something that's actually been very surprising amidst the tariff tantrum is that we've had a tremendous, and this is month over month data, and particularly September in this green line, we've had tremendous inflows of foreign capital into our domestic markets here. Wouldn't have expected that back in April, obviously. It seemed like our administration was trying to irritate the rest of the world, and it seemed like they were doing a great job at it. But investors think differently. We've had a weak dollar, and so that creates different dynamics. So you've got inflows here on treasuries. Certainly on the equity side, we've seen foreign investment in our domestic markets really spike there, and then even some of these other categories, you get corporates and agencies as well. So strong foreign liquidity entering our market, that's helped to sustain our market expansion here, and it's been a very important influence in our market over the last several years anyway. We got fund flows that we were just talking about. Well, we'll just talk about like categorically where we're seeing it overall, and this is not the foreign investment. This is just all together. And you can see here, money market fund flows are still pretty strong. Entering in November, last several weeks though, we've seen some notable outflows from money markets into the fixed income markets. With this theory or this premonition that a lot of people have that interest rates are coming down, so that would obviously help prices, and so we see a little subtle shift here in how those fund flows are happening here in our domestic markets. Panic index, this is extremely noisy. I don't look at this terribly often, but panic seems to be relatively high, which I think would dovetail a little bit with some of the recent volatility that we've had, where tech stocks had corrected 10%. The overall market was down 5% from its peak. Tend to correlate there, but I think when we talk about the timing of this and kind of the lagged effect, I would probably expect to see that panic indicator come down unless we get some new data, compelling data that kind of reinforces this notion of slowdown. We'll talk about market cap for U.S. investment grade and high yield markets, $11 trillion. You can just see how that has expanded over the years, and I think I call it the interlinings of this is that we're seeing a real rapid rise in private credit amidst all of this, and you can see where most of this growth is coming in. Call it the A- and triple B level, and so triple B minus represents that threshold below which everything's kind of like high yield or high risk, and everything above that would be lower risk. But you see a lot of issuance in that triple B category right now, a lot of supply. Interesting note here. We talk about the Mag 7 and these tremendous equity valuations, but let's not lose sight over the fact that these companies are borrowing a lot of money, and it's very circular, right? I mean, this is one of the risks of the AI. A lot of people talk about the AI bubble because you've got a lot of these companies that are buying from NVIDIA, and it's kind of a circular relationship, and their capital spending plans are out the roof. And to fund that, they are borrowing a lot of money, and we've got over $100 billion here of issuance on the part of these players alone. You can see how that compares rather dramatically with the historical backdrop. And then this is high yield fund flows, and this is highly rated credit, but this kind of goes back to our last slide that high yield, a little bit of stress being perceived in the market because we're seeing some people kind of pedal off the fund flows. Now we've got our yield curve, which kind of helps well, at least from a bond market perspective, it's a gauge of the health of the economy. So when you have an upwardly sloping yield curve, and you can see the slope of the yield curve here, looking at the difference between 2-year Treasury yields and 30-year Treasuries, is kind of holding steady around 100 basis points. And so again, we have a positively sloping yield curve, which when you think about how fixed income is priced, I mean, you have a obviously a risk premium, a credit premium, and you also have a time premium that gets added. And so typically, there's more risk over a longer period of time, which you get compensated for by these higher yields. And that's exactly where we are now. So this is a very relatively healthy market, even though we've got a bit of a kink in the yield curve at the short end. 10-year Treasury yield that we've been looking at has eased down to 4%. We expected here, probably in the September timeframe, when we got that first cut, that we would see some downward sloping Treasury yields at the longer end of the curve. Again, the Fed doesn't influence that. This has a lot to do with inflation expectations and what's being built into that term premium. And again, we see those rates coming down. This is influential when you talk about mortgage rates because they are, in large respects, indexed to the 10-year Treasury. And so we see some positive developments there, which is helping affordability a little bit. We talked about gold, and gold is having a banner year. And I thought this chart was particularly interesting because when you look at supply, I mean, we're recycling gold and putting it back into the market. And then we have a little bit of mine production here, right? And so you've got the miners that are active, right? And so and the relatively muted influence here on supply from mine production is one reason why it's important to, if you're going to buy gold, you got to make sure, are you buying the metal or are you buying the miners, so the producers of it, and because they can act quite a bit differently. Now, on the demand side, which is really interesting here, and you see jewelry has been kind of a net drag on that, technology a little bit of a net drag, and yes, there is gold that goes into high-performing electronics, but really helping demand and helping to drive net prices. You see supply is up in tonnage, but demand is up a lot more, and you've got central banks that are buying this. Okay, so this is very important. ETFs and financial products, yes, where they have to hold a requisite amount of gold for the amount of ETF issuance that they have, and you've got like minting, or I guess bar and coin demand. But the central bank number is really astounding here because we see a kind of a sea change a bit in how reserves are managed. We're seeing a disintermediation away from U.S. Treasuries and increased investment into gold. We look at the commodity sector a little bit. We've had some puts and takes here. We see the commodity basket really over the last week shows some erosion. Again, this data can be very noisy. Gasoline, and I've got some few charts, but we've seen cattle prices really high. We've seen soybeans at a higher level, and corn, and some of these other kind of commodities, and some of these are impacted by tariffs or by markets being inaccessible because of tariff-related barriers and things like that. But the commodity basket seems to be coming down a little bit into a more favorable level. We got crude oil here. We see crude oil going down again. When you hit anything below $60 a barrel, you begin to speculate, about domestic production and who can produce it efficiently and with positive margin at these levels. So, and some of this does have some seasonal impact, for the driving season. But I'd say by and large here, this is something that we'll be watching coming up, because obviously if you assume you're going to have more consumption, economic growth, that generally would drive prices a little bit higher, but it's probably offset by increased production right now. So we got live cattle futures here, as I mentioned, had been high. You just have to go to the beef counter at your supermarket and you'll know what I'm talking about. Futures have come down, so that's a little bit of a relief. I know we've had some real thinning of herds here over the last couple of years, and that's impacted the supply of beef. Corn a little bit more volatile. We see corn prices moving higher. Obviously, there's a lot of corn that goes into ethanol. So this has some tie to gasoline demand. You can see basically that this has corrected a little bit and is kind of like punched through its 50-day moving average. So again, commodities are moving in different directions, but overall commodity basket looking a little bit more favorable here in the last month of the year. So we've got the dollar. Dollar had been moving lower, and then if you go back to really beginning of October, we've seen a little bit of relative dollar strength. And this is, when you think about like going 97 to 100, that's about a 3% move here in the U.S. dollar index. Last slide here, we've got Bitcoin. Again, need I say more? There's a lot of people that have played Bitcoin and have done reasonably well in it, but it's one of those things that you have to be eyes wide open. And we've had a 20% reset in Bitcoin, and again, we had a lot of movement in some of the tech stocks, admittedly. But so Bitcoin is just very volatile. So I just want to, we've got a lot of clients and a lot of friends of the firm that have Bitcoin Coinbase accounts where they own crypto. And again, if you understand that volatility can hit you pretty hard sometimes, and as long as you're prepared for it, and this is not the bedrock of your portfolio, you should be able to weather that storm. So all the charts that we have this week. Hope you have a great week as we enter the month of December. We get ready for 2026. Talk to you soon. Have a great day.